I'm glad to welcome you to the Manifested e-learning platform. And today we continue with the subject Advanced Financial Management. The topic is mergers and acquisitions. We're going to study the problem of overvaluation in mergers and acquisitions. And in this lesson, we will highlight the causes of overvaluation. We'll discuss the impact of overvaluation and how to mitigate overvaluation. That is what we intend to do in our today's lesson. And mergers, candidates, and acquisitions, we all know by now, are strategic tools that companies use for growth, for market expansion, and synergy creation. But mergers and acquisitions can also pose a challenge that can often lead to failure. And one of the causes of failure in mergers and acquisitions is the problem of overvaluation. And overvaluation occurs when an acquiring company pays more for a target company than its true intrinsic or market value. And that can severely undermine the success of mergers and acquisition deal and lead to disappointing returns on investment. It can also lead to financial strain and even the value destruction for the acquiring entity or firm. So studies have also shown that a high percentage of mergers and acquisitions deals fail to create value, with overvaluation being the major culprit. The reason why most mergers don't succeed is because of the problem of overvaluation. So then the question we need to answer is, what is the cause of overvaluation of mergers and acquisitions? One, there are several factors, there are several causes that contribute to the overvaluation of a target company in mergers and acquisitions. And one such factor is being overly optimistic about the projections, or what you can just say, unrealistic expectations. One, unrealistic expectations. Being overly optimistic. Overly mistic projections. Overly optimistic projections is one factor that can lead to overvaluation of a target in mergers and acquisitions. Overly optimistic. Acquirers may have an exaggerated view of the target company's future growth, revenue potential, or even anticipated synergies. And this optimism can lead to a willingness to pay a premium that isn't justified by realistic financial forecasts. So that can lead to overvaluation. Number two, inadequate due diligence. Inadequate due diligence. That means rushed or incomplete due diligence can be a primary cause of overvaluation. If the acquiring firm fails to thoroughly scrutinize the target's financial health or even operational efficiencies, hidden liabilities, and market position, it may miss critical information that could have led to lower valuation. Pressure to close the deal. All right? In a competitive bidding wars, or when there is a strong internal pressure to close a deal quickly, acquirers might compromise on their valuation discipline. There could also be emotional attachment to a strategic acquisition that can also lead to irrational and overpayment, irrational exuberance and overpayment. The fourth cause of overvaluation of a target is one related to the agency problem or managerial hubris. Agency problem. Managers might pursue merger and acquisition deals that benefit their own interests. For example, increased compensation or even larger empire rather than shareholder value. Furthermore, there could also just be hubris, which is an overconfidence in the ability to integrate and improve the target company, which can lead also to overpaying. Flawed valuation methods. Now, flawed valuation methods can also lead to overvaluation of a target. Using inappropriate valuation models, making incorrect assumptions about, say, discount rates, growth rates, or terminal values, or even just failing to account for market shifts can result in inaccurate valuation. 6. Miscalculation of synergies. Miscalculation of synergies. While synergies like cost savings, like revenue enhancements are key driver of mergers and acquisitions, they are often overstated. And if the projected synergies don't materialize, the premium paid for them turns into overpayment. 7. Market conditions. Market conditions. Now, a hot M&A market or inflated stock prices can encourage overpayment, as companies may feel pressure to acquire to keep up with the competitors, or even just use their own overvalued stocks as a currency for acquisition. So market conditions can also lead to overpayment of a target. 8. The 8th cause of overvaluation of mergers could just be poor advice. Being advised poorly by consultants. Okay? Poor advice from advisors. And these advisors could be investment bankers who earn higher fees when deals close, and they may not always provide unbiased valuations, which may push higher prices to secure the transaction. So these are 8 causes of overvaluation of a target. Now let's discuss the impact of overvaluation. What is the impact? What is the impact of overvaluation of a target? Now, the consequences of overvaluation can be severe and far-reaching, and one such impact is financial strain and reduced return on investment. ROI. Financial strain and reduced return on investment. Overpaying can deplete the acquiring company's cash reserves. It can increase debt levels and ultimately lead to a lower return on investment for shareholders. Impairment. When the acquired assets are recorded at a higher value than their actual worth, it creates goodwill. And if the acquisition underperforms, this goodwill needs to be written down, leading to significant accounting losses and impacting the acquiring firm's financial statements. Goodwill impairment. value destruction. Shareholder value destruction. Now, ultimately, overvaluation often leads to a decline in the acquiring firm's stock price as the market recognizes the value destruction caused by the overpayment. Integration challenges. This is yet another impact of overvaluation of a target. Financial stress from overpayment can divert resources away from critical post-merger integration efforts, which may increase operational disruptions and also cultural clashes. Credibility. Loss of credibility. Loss of credibility. A track record of overpaying for acquisitions can damage the acquiring company's reputation and make future mergers and acquisition endeavors more difficult and expensive. So these are 5 impacts of overvaluation of a target. Now then, how can this overvaluation be mitigated? Mitigating overvaluation. How can mitigation of overvaluation be done? That's the question we need to answer. How can overvaluation be avoided? So to avoid the problem of overvaluation, companies undertaking mergers and acquisitions should first of all conduct rigorous and independent due diligence. 1. Due diligence. Conducting rigorous independent due diligence can help mitigate the problem of overvaluation. What does that mean? That means going beyond the information provided by the target company and its advisors. If you're acquiring a company, don't wholly rely on information provided by the target. Carry out a rigorous independent due diligence. That can help the acquiring company to avoid the problem of overvaluation. The second way is employing multiple valuation methodologies. Employing valuation methods or methodologies. Multiple, various valuation methods can be used using a combination of income-based, market-based, and asset-based approaches to get a comprehensive view of the target's value. Don't just rely on one method. Have a combination so that you can avoid the problem of overvaluation. The third way is to establish what we call a walk-away price. Establish a walk-away price. Establish a walk-away price, or what we call stick to it. Stick to it. Avoid emotional bidding, especially the wars. Emotional bidding wars should be avoided. That can help the acquirer to avoid overvaluation. 4. Be realistic about synergies. Be realistic about synergies. And that can be done by conducting thorough analysis to ensure projected synergies are achievable and quantifiable. Achievable and quantifiable. 5. Number 5. Align incentives. Align incentives. What does that mean? That means that the acquirer should ensure that the management compensation is tied to actual value creation from mergers and acquisitions, and not just deal completion. And not just deal completion. 6. Seek independent financial and legal advice. Seek independent financial and legal advice. The acquirer should engage advisors who are truly independent and prioritize the acquiring firm's long-term value. 7. On strategic fit. Focusing on strategic fit and not just size. The acquirer should ensure the acquisitions aligns with the company's long-term strategic objectives and offers a genuine competitive advantage. So these are 7 ways to mitigate overvaluation of a target in mergers and acquisitions. And that is the end of the lesson. In this lesson, candidates, we've discussed the problem of overvaluation. We've identified 8 causes of overvaluation, beginning with the being overly optimistic in regards to projections, inadequate due diligence, pressure to close the deal, agency problem or managerial hubris, flawed valuation methods, miscalculation of synergies, market conditions, and poor advice. These are 8 causes of overvaluation of a target in mergers and acquisitions. In this lesson, we've gone ahead to discuss the impact of overvaluation of mergers and acquisitions. One impact is a financial strain and reduced return on investment. Number 2, this can lead to impairment of goodwill. Number 3, shareholder value destruction. Number 4, integration challenges. Number 5, loss of credibility. Then in closing this lesson, we've identified 7 ways to mitigate overvaluation of a target in mergers and acquisition. 1 is conducting rigorous independent due diligence. Number 2 is employing multiple valuation methodologies. 3, establishing walk-away price. Number 4, being realistic about synergies. Then number 5, aligning incentives. Number 6, seeking independent financial and legal advice. And lastly, focusing on strategic fit. Focusing on strategic fit. And candidates, by being disciplined and thorough in their approach, companies can significantly reduce the risk of overpaying in mergers and acquisition deals and increase the likelihood of value creation. That is the end of our today's lesson. Bye-bye.